At January 1st, 2020, Baker Corp reported retained earnings of $2 million. In 2020, Baker discovered that 2019 depreciation expense was understated in error by $500,000. In 2020, net income was $800,000 and dividends declared were $195,000. The tax rate is 25%. Baker follows ASPE and the deferred taxes method of accounting for income taxes. Prepare a 2020 statement of retained earnings for Baker Corp. Briefly explain how your answer would change if Baker were to follow IFRS. Okay, let's create a statement of retained earnings then. So the first thing we're going to do is set it up with proper form. So we're going to have Baker Corporation statement of retained earnings and the date, which is going to be it's 2020, so it's going to be December 31st, 2020. Okay, so we've got, we're always start with our opening retained earnings. So we're going to have retained earnings 1/1/2020 as previously reported. That's how we started off, because we're not going to restate our opening this way. We need to make sure the reader understands that we've restated our retained earnings. Okay, so as previously reported, they had reported retained earnings of $2 million. So let's put $2 million here. Okay, and then now we are going to have the correction of depreciation error, net of tax. And we're actually going to show what the tax is. So we're going to say net of tax of blank, blank, blank. So what is our correction of the depreciation error? Well, it's $500,000. But remember that we always report retained earnings as an after-tax concept. So after tax, this is $375,000. So 500,000 times 1 minus 25% is going to give us 375,000 here. And how much tax did we take off? Well, 500 minus 375 is going to say net of tax of 125. That's the amount of tax we just took off with that math we just did. Then we're going to report retained earnings 1/1/2020 as adjusted. So this is our adjustment to our opening retained earnings. So you can see we're letting the reader clearly see we had reported 2 million. Now we've increased it by 375 because of the fact that actually we've decreased it by 375. So now our retained earnings is going to be 101.6 million because this was an error where we had understated depreciation. So this is an expense. We should probably just have this as an expense, but now I'm just going to have to change my formula to make that work. Okay, so there's our corrected retained earnings. Now we're going to, of course, add net income. We're told that net income was 800,000 and subtotal so the sum of these two. And then we're going to have deduct dividends. Remember how dividends go through retained earnings, deduct dividends. So we're going to deduct this 195,000. None of these numbers change. We just need to pull them through. So then we're going to have retained earnings. Whoops. Now we're going to have retained earnings 12/31/2020. And it's simply going to be the sum of these two. And there's our retained earnings. So we can see here, the most important thing that we're focused on is this piece, which is this correction of the error. So we have included a line saying retained earnings previously reported. We've got the correction of our depreciation error, which is net of tax for retained earnings. And we disclose the amount of tax that we took off. So you can see the 375 plus the 125 takes us back to the $500,000 correction we were given in $500,000 correction we were given in the question. And then we're simply continuing with our statement of retained earnings, which is adding net income and deducting dividends. Now, B says, how would your answer change if Baker were to follow IFRS? Well, as we learned previously, this is the statement of retained earnings is for ASPE, and IFRS would still disclose the error and have the exact same calculation, so no change there. But for IFRS, we would need to prepare a statement of changes in shareholders' equity rather than the statement of retained earnings. So that provides some more information. We'd also need to make sure that we disclosed our adjusted basic and diluted earnings per share as a result of the calculation, because IFRS is public companies, so it means that earnings per share could come into play there. And that takes us through the conclusion of this question.